Welcome back to this tutorial. In this session, I'm going to demonstrate and prove what will come to be known as biggest profit opportunity, which we can shorten as BPO structure. So biggest profit opportunity structure. Your job will be to identify the structure every time and then to leverage it in your forecast for your entry projection. Now, this is something that happens mainly during the trend when there is an impulsive trend move that gets corrected. So I've used two I've used two tools to mark what the structure looks like, and you can also do the same thing. So the first structure is the correction structure. Now, the simple rule of thumb is to watch for any correction that makes a complete 200 pips impulse. In other words, when you find an R3 event that is a correction of a bullish trend, okay, or a G3 or uptrend, a correction of a G3 or an uptrend, and your correction happens to be over 200 pips of impulse. So 200 pips of impulse. The rule says that the expectation is for the market to recover the full correction move and double it. So the rule says your expectation is for the market to recover the full correction move and double it. So your job then is to look out for such corrections, not before the correction, but after the correction. So before the correction is not your concern, because what happens and all the move that happens during the correction will be your profit move when trading after the correction. So which means you are watching for another thing that can help you trade reversal patterns. Reversal patterns. So in general, this can also fall under the reversal pattern trading. So you are going to use this to track it every time and trade it consistently profitably for the biggest profit opportunity. So this is the structure you are watching for. So again, let's look at the rule. First of all, you want to identify any correction. In this case, if our trend is bullish, then the correction should be bearish. Is that not so? So it means that we are having uptrend, then a correction happens in that uptrend that makes an impulsive move exceeding 200 pips in one impulse. And if that impulse is a correction wave, then you expect that the market will recover that correction wave, which means the market will return back above the G above the what TL, that is the trend low of that correction wave, since the correction waves goes to set a new trend low. So the market will recover from the trend low of that correction wave, also known as the TCL of the correction wave, okay, and then recover to the ISL of the correction wave. So which means in this case we are having TCL to ISL move in an upward direction when the correction was a downward correction, okay, or TCL to ISL move in a downward direction when the correction was what, an upward move. So the trend first will have to be identified. So where the trend is bullish, correction is bearish, then the recovery will be bullish. So how do you take your entry on the correction? You follow the end of expansion rule. Remember that expansion is what? a market moving further in the direction of correction after breaking the TCL, also called the trend low. So once you see a TCL that is broken, and of course we use the 10 pips break to find our entry. So once the TCL is broken by 10 pips, and that's the correction TCL or trend low TL, then you set your entry as a what? A stop order entry, 1 pip above the TL that has just been broken. So when the market returns back from the expansion, okay, of that TL. Remember, expansion limit we have done in a previous tutorial is usually 30 pips from what? The level that is broken. 30 pips from the level that is broken. And here we have the TL as 2305, which means that its expansion limit will be what? 2302.87. So let's look at it. 2302.87. You can see that the market did not go to the what? The market did not exceed the what? The market did not exceed the deviation limit of this TL. So that's the point, which also shows that the market cannot continue in a downward move. Now, apart from the market going into its deviation limit, which we also call in this case expansion limit, because this is not of an SBL but of an impulse. Okay, so not of a string break entry rule but of an impulse level. So we refer to the market breaking the TCL as an expansion, hence the 30 pips break is what? The expansion limit. So the market did not break the expansion limit of the TCL, which means that the market is not going to have the momentum for going further downward. So that having been said, now the entry is activated at what? 2305 point, yeah, 2306.02. That will be the entry price. And once activated, the market is expected to first of all go and recover the full move of the correction, which is what happened here. And after that, we'll say